All right, let's talk about something huge that happens almost silently. On just one single day in November, more than $76 billion is going to be forced to move across stock markets all over the world. And it's not because of some big economic news or a market crash. Nope, it's because of a scheduled update, a quiet event called the MSCI Index Review.
So that's the big question, right? How on earth can just updating a list trigger a $76 billion global trading frenzy? It sounds kind of crazy. Well, that's the mystery we're going to unravel today.
Here's the game plan. First, we're going to set the stage and see what this whole reshuffle is about. Then, we'll follow the money and see who the big winners and losers are in both developed and emerging markets. After that, we'll zoom out to see the true scale of all this trading. And finally, we'll pull back the curtain on the invisible, automated engine that makes this entire thing run. All right, so to really get the impact, we first have to understand what's actually pulling the strings here. It all boils down to something called the MSCI indexes. The best way to think of them is as these super influential shopping lists for the stock market. You see, massive investment funds like the ETFs many people have in their retirement accounts are built to perfectly mirror these lists. So if a stock gets added to an MSCI list, these funds are literally forced to buy it. And if a stock gets dropped, you guessed it, they're forced to sell. It's not a suggestion, it's a rule.
So MSCI just announced its latest quarterly review. And on November 24th, a whole bunch of companies are getting added to these indexes, and another bunch are getting kicked off. Every single one of those changes creates a ripple effect. So let's start by following the money in the developed markets to see who the biggest winners and losers are in this giant shuffle.
And wow, the impact is immediate and it is massive. Germany is looking at a net inflow of over $1.5 billion. Japan's going to see over $1 billion. But on the flip side, look at Switzerland, facing an outflow of over $2.2 billion, with France not too far behind. Remember, this is money that has to move no matter what the market is doing that day.
But these net numbers don't even tell the whole story. Take a look at Japan. To get to that $1 billion net inflow, funds have to buy over $3 billion worth of stocks while selling about $2 billion. But for Switzerland, it's almost all one-way traffic. A massive $2.2 billion sell-off with almost nothing coming in. That is some serious financial pressure created by one simple update.
And if you thought that was dramatic, the story gets even more interesting when we look at the shifting tides of capital in the emerging markets. Over in the emerging markets, China and Taiwan are the clear winners. They're set to pull in nearly $1 billion and $650 million in new investment, respectively. But at the same time, markets like Saudi Arabia and Greece are about to see major outflows, almost $500 million each. For economies of their size, these are enormous capital shifts.
And again, when you dig into the numbers, you really see the pressure points. For China, funds are going to be executing almost $3.7 billion in buys against $2.7 billion in sells. But check out Greece and Saudi Arabia. It is a one-way street. There are no significant companies being added, so it's all selling pressure. Almost $500 million flowing out of each market just like that.
So we've seen where the money is going, but let's just take a step back and appreciate the sheer volume of this event. This is what's called turnover, or, the total market churn.
Get this. In developed markets alone, the total value of these forced trades, that's all the buying plus all the selling, adds up to an incredible $52.6 billion. And this all has to happen pretty much on one day to make sure the funds keep tracking that index perfectly. In emerging markets, the total trade value is a smaller but still massive $23.8 billion. But here's the thing, the dollar amount doesn't tell the whole story. The really crucial point is the intensity of that trading. This is where it gets really fascinating. The turnover rate, which is basically just the percentage of the index that's getting a makeover, is more than double in emerging markets compared to developed ones. What does that tell us? It tells us that, relative to their size, the investment landscape in emerging markets is being reshuffled way more aggressively. It's a sign of a much more dynamic and rapidly changing economic environment. Okay, so this brings us to the final and maybe the most important question of all. Why does this matter? How does this whole thing even work? Well, welcome to the automatic market. It really comes down to this simple four-step mechanical process. Step 1, MSCI announces the new list. Step 2, trillions of dollars in passive funds are benchmarked to that list. Which brings us to steps 3 and 4. These funds are required to buy every single new company and required to sell every company that got dropped. This has nothing to do with what an investor thinks about a company. It's an entirely automated, rules-based trade happening on a global scale.
And that leaves us with a pretty fascinating question to chew on. When tens of billions of dollars are moved, not because of what investors are feeling or because of how well a company is doing, but by an automatic reaction to a list being updated, it really makes you wonder who, or maybe what, is truly in control of the market these days.